26 years old, share house in Footscray, 3 housemates, 1 bathroom, a parking spot that isn't yours but you use anyway, analysis role at a firm in the CBD, 3 years in. You pack lunch every day except Friday. The phone is face up on the desk. The screen is on. An email from HR sits at the top of the inbox. Subject line, remuneration update, effective 1 July 2026. You open it. New base salary, $100,000 per annum. You read it twice, not because you misread it, because you want to feel the number land the way you always imagined it would. You've been holding this number for years, not as a goal exactly, more like a line in your head, the line where things get easier, the line where the version of yourself that's always slightly behind finally catches up. The phone screen dims. You tap it back on. The number is still there. What you feel is harder to name than you expected. You remember when $100,000 meant something specific, not just financially, symbolically. It was the salary on the LinkedIn profiles of people who seemed to have sorted it out. The income bracket that sat comfortably above the national median. The number that appeared in conversations about property deposits, overseas holidays, investment accounts, things people spoke about without lowering their voice. You did the maths once, years ago. $100,000 divided by 52 weeks, just under $2,000 a week before tax. That's real money, you thought. That's the kind of number that changes things. You were 23 when you wrote it in the Notes app on your phone. You were sitting in a share house in Footscray, 3 people to a 2-bedroom, and the $52,000 starting salary felt like a beginning you could work with. Finish line, $100K. You are not 23 anymore. The payslip arrives 3 weeks later. You open it the way you always open payslips, quickly, then slowly. The gross figure sits at the top, $3,846 per fortnight. That's what you earned. Then the lines begin. Income tax withheld, $799. Medicare levy, $77. Help repayment, $190. The compulsory superannuation sits outside the salary entirely, 12% on top, going somewhere you can't touch until you're 60. What lands in your account is $2,780, not $3,846, $2,780. The advertised salary and the usable salary are not the same figure. You knew this, technically, but knowing it and watching over $1,000 vanish before the money reaches you are different experiences. The help debt alone will follow you for years. You finished your degree in 2019. The balance was indexed to CPI every June until the government's 20% debt reduction passed in 2025. You've made compulsory repayments for years. The balance is still there. $2,780 arrives on Thursday. Now you need to figure out where it goes. You open a real estate app on the weekend. Not to buy, just to test the feeling of someone who earns 6 figures looking at rental listings. 1-bedroom apartment, in a ring suburb, air conditioning, commutable. $520 a week. You do the maths. That's $2,180 a month. Against $5,560 monthly take-home, leaves $3,480 for everything else. You move the filter outward. $390 a week. Better. The commute goes from 20 minutes to 55 minutes. You remember the first rental inspection you ever attended. You were 24. 43 people in a queue outside a 1-bedroom in Brunswick. The agent had a clipboard. You filled in the form standing on the footpath. You didn't get it. The market hasn't slowed since then. The listings were there before your payslip arrived. They'll be there after. A 6-figure salary gives you access to slightly better options within the same category. The filter moves, the circumstances don't. The first full month inside the new salary is a problem in 2 columns. Column 1, $5,560 monthly take-home. Column 2, rent $1,620, electricity $210, internet and phone $115, private health insurance $148, groceries $380, public transport $200, streaming subscriptions you haven't fully audited $67. What remains? Roughly $2,800. From that amount comes every medical expense, every social obligation, every piece of clothing that wears out, every time the dentist finds something. You're not counting coins. You're not lying awake calculating what fails if one payment is late. But you are also not accumulating in any meaningful sense. The money arrives, the money deploys, the month ends. Comfortable and stationary simultaneously. Your mate bought a house, not a unit, a house, in a suburb 40 minutes from the CBD. He earns, you reckon, somewhere close to what you earn. You asked carefully how the deposit worked. His parents contributed $160,000. Not a loan, a gift. His parents owned 3 investment properties in Melbourne's Outer East. The rental income funded the gift, structured through a family trust established in 2011. He is not further ahead because he earns more. His income is comparable. He is further ahead because a structure built before he was employed transferred wealth to him in a form a salary cannot replicate. You think about another friend. Her help debt was cleared by her parents in a lump sum at 25. She's been redirecting those compulsory repayments into an index fund since 2023. 3 years of compounding in an ETF is a different financial position than 3 years of repayments disappearing into consolidated revenue. Same income, not the same position. Income is one variable in an equation you were never shown in full. Here is the thing you weren't told. Income earns money. Ownership multiplies it. These are not the same mechanism. They do not operate on the same logic. And the Australian system in 2026 rewards ownership with a structural generosity it does not extend to labour. None of this is illegal. None of it is hidden. These are simply the rules as they exist. Consider 2 Australians. Both received $100,000 this year. The first earns it as a salary. It's assessed at the marginal rate the moment it arrives. At $100,000, the marginal rate is 30%. Income between $45,001 and $135,000 sits in that bracket. Medicare adds 2% on top. The money is processed before it reaches the account. The second receives it differently. She bought an investment property 6 years ago. This year she sells it. The capital gain is $200,000. But because she held it for longer than 12 months, only half of that gain is taxable. She is assessed on $100,000, not $200,000. The same dollar measured by a different ruler depending on how it arrived. Now consider the salary earner again. His investment property runs at a rental loss. Rates, maintenance, the gap between rent collected and mortgage interest paid. That loss reduces his taxable income. The cost of owning an asset reduces the tax on his labour. His salary and his property interact inside the tax system in a way that benefits both. Your salary interacts with nothing. It arrives alone. Franking credits work similarly. 2 people receive $10,000 from their investments. One receives it as salary, one receives it from dividends from Australian shares, which carry a tax offset for the corporate tax already paid inside the company. The dividend income comes pre-credited. The salary income does not. Superannuation sits at a concessional tax rate of 15% during accumulation. Your employer contributions go in at 15%. When you eventually draw a pension from it, earnings inside the fund are taxed at 0. The government decided deliberately that money accumulated for retirement should be taxed less than money earned today. The logic is coherent. But the benefit compounds most aggressively for those who can afford to contribute above the compulsory 12%. The rules are published, ATO website, Treasury papers, electoral platforms, available to anyone who reads them. The rules, however, are most useful once you have the capital to activate them. A 6-figure salary positions you inside the system. It doesn't position you above it. The top of the system is not an income level. The top of the system is an ownership portfolio generating income without labour. Income the system taxes more leniently, offsets more generously, and compounds more reliably than anything a payslip produces. What you were told was earning was the goal. What you were not told is that earning and owning are different games with different rulebooks, and that the second game was designed before you were born by people already playing it. You were running a race on a track the rules didn't count. There is an older version of what $100,000 meant. In 2005, the median Sydney house sat around $450,000. A 6-figure salary bought genuine options. The income to property ratio, the rent to income ratio, the cost of a weekly shop against what landed fortnightly, all of it sat differently. The benchmark was set at a real moment in time by people for whom the benchmark was real. In 2026, the economy has moved continuously. The cultural milestone did not move with it. The finish line was described to you accurately, for a different race in a different decade by people who reached it when reaching it still meant what they said it meant. You are not poor. You understand this. The median weekly earnings in Australia in 2026 sit around $1,425, roughly $74,000 a year. You earn above it. You have a super balance accumulating. Your costs are covered without catastrophic stress. But wealthy is a word you've been quietly revising. At 23, wealthy meant $100,000. At 29, wealthy means something harder to locate. It means owning something that moves in value while you're asleep. It means not needing the salary to continue for the position to hold. By that definition, $100,000 is not wealthy. $100,000 is comfortable precarity. Housed, fed, financially functional, but not compounding. Your mum asked if you were going to celebrate. You went to dinner. You ordered what you actually wanted without running the arithmetic first. It felt genuinely good. Then Monday arrived. The commute was the same. The month-end figures came in slightly better. Somewhere underneath that was a feeling you couldn't name cleanly. Not failure, not ingratitude, something flatter. The version of yourself you'd been building towards didn't step forward. What stepped forward was the same person. The phone is face up on the same desk. Same Footscray share house, different room now, you got the bigger one when Jake moved out, still 3 housemates, still 1 bathroom, still packing lunch every day except Friday. A notification appears. New base salary, $150,000 per annum. You read it. You sit with it for a moment. This is the number that $100,000 was supposed to turn into, the next milestone after the milestone. You remember a conversation at a work function 4 years ago. Someone said $150K is where it actually starts to feel different. You open the payroll calculator. $150,000 gross. New fortnightly take-home, approximately $4,237. You close the app. You think about the share house in Footscray, the rental queue in Brunswick, the mortgage browser you opened and closed, the payslip with $2,780 at the bottom, the friend who got the house, the friend who cleared her ELP debt, the CGT discount, the family trust from 2011. The system did not change. You just moved to a higher entry point inside it. And somewhere right now, someone is staring at an email that says $100,000 for the first time. They're in a share house. They did the maths in the notes app. They think this is the line where things get easier. They're waiting for the feeling to arrive properly. You spent years trying to reach 6 figures. What you actually reached was the beginning of a different level.